Some closing market thoughts here for the big picture discussion. He's a senior investment strategist at Charles Schwab. Good afternoon, Kevin. What are you watching for in a holiday shortened week?
I think, just the recovery from what was a pretty brutal, day, obviously, after the Fed last week, just to see the nature of the bounce and some of the recovery in things like sentiment. And I think what was interesting was that on last Wednesday, there was a pretty significant washout across a lot of sentiment metrics, not as much on the behavioral side, more so on the attitudinal side. But some of the even spikes that you saw in, new 1 month lows, whether it was in the S&P or down the cap spectrum, which it was a little bit more aggressive down the cap spectrum, a lot of that activity actually looked consistent with what you would see at the end of a bear market, not necessarily at the end of a bull. So I thought it was kind of interesting to look at the context of that. It at least says to me right now, given longer term breadth is still relatively healthy, that you haven't really disrupted this uptrend. It seems like a relatively, if you want to use the word viable pullback, I don't think it's, I don't want to suggest that it's a get in or get out moment, but I think that in the context of the uptrend that we've been in this year, it's still a pretty healthy looking market heading into the end of the year.
Okay. The deterioration of the lower quality bracket of stocks, I guess, kind of fits into your guys' thesis, right? You can get quality outperformance one of two ways, quality going up more or quality going down less. Last couple of weeks has been quality going down less, right?
Yeah, and I think, quality is funny how it moves around from group to group in this market. And one of the you could definitely say one of the star performers over the past month and a half, really since the election, has certainly been the Magnificent Seven as a whole group. Performance within that group is, of course, not always the same because you've got the likes of Tesla rallying much stronger than the likes of NVIDIA. But if you were to look at it as a group, generally thought of as higher quality because of the cash positions, because of the relatively healthy balance sheets. But there are times when that quality aspect sort of moves out of that group, and then investors start to favor broadly the S&P 500, but not necessarily the small cap. So it moves around, and it's pretty jumpy, for lack of a better term. But that's for the most part what we've seen throughout this entire year, and we expect that theme to continue, albeit in 25, probably with a little bit more headline volatility or volatility at the index level. So I don't think that over the past week we should expect days like we had on Wednesday and Friday every single day. But I think that kind of volatility that has started to now seep into, the headline index level is probably something that continues heading into the new year.
Hey, I'll kind of push you to maybe think about bonds with me a little bit, because I know you do. Kevin, we had a conversation at the top of our show with Bob Conzo, and we were talking about the trade-off between bonds and stocks from kind of like a from a perspective of talking to family members this weekend and this week at holidays, when they go, hey, I can get 4.4% on a 3-year. Should I do that instead of buying stocks? What are you telling them?
Well, I don't think it's ever an instead of. I think it's always in addition to. There's often, I think, just too much discussion about pitting bonds and stocks against each other. And, I understand that from the standpoint of, in the post-financial crisis era with yields being relatively low, if you exclude, of course, the past few years, I understand that argument, or why, the TINA sort of framework lived for so long. But if you're looking at it from an income generation perspective, then, fixed income is still relatively attractive. And I think that's how most investors, at least that, we talk to, try to approach it. Nobody's really trying to time the bond market in terms of getting the very best return that you can get. Number one, not only has that been a tough thing to do over the past couple of years, but number two, the cushion that you get from the yield and the coupon portion, ends up being a little bit more important over time. And you can actually look back to the 70s and the 80s, when, of course, yields were spiking and returns looked pretty bad in terms of the price return standpoint. But if you look at what you were getting from the coupon and from the yield, that was actually outweighing the weakness from the returns. So you actually had, at the end of the day, a positive return in most cases. So I think that's how investors should look at it. The signal, I think, that should be taken from fixed income is more so just the relationship that bonds have with stocks. So if anything, it's a better sort of mechanism or market to look at, that being fixed income, to see what the actual problem is facing the economy, and then by virtue of the market, if there is this negative relationship between bond yields and stock prices, then you have more of an inflationary issue. And I would argue that that's probably why, the Fed stays on hold maybe for a little bit longer next year. And that ends up being probably a negative thing for equities in the beginning. But I think then you go through a digestion period and then they're able to adjust.
Understood. Nice closing thought. I think for the year, have a great holiday to you and your family. Thanks, Kevin Gordon.